Current market action for Snowflake Inc., ticker symbol SNOW, is painting a chaotic picture on the charts right now, with the stock trading live at $239.59 per share. This represents a significant intraday decline of $25.41, or approximately 9.59%, bleeding red across trading monitors as we speak. If you are watching the ticker tape on your Fidelity mobile app or tracking the heavy volume through Interactive Brokers' trading platforms, you are seeing a classic Wall Street punishment unfold in real time. The expectation going into this morning was sky high. Investors were positioned for a perfect beat and raise scenario that would justify the company's premium valuation. The reality, however, has been far more nuanced and, frankly, misunderstood by the knee-jerk algorithmic trading that dominates the first few hours of the session. While the headline numbers from the earnings report released late yesterday actually beat analyst estimates, the market has fixated aggressively on a single metric, operating margin guidance, and is pricing in a disaster scenario that simply does not align with the fundamental health of the business. This massive gap between the market's panicked expectation of slowing efficiency and the reality of a strategic capital deployment creates one of the most interesting setups we have seen in the cloud software space this year. To understand why a company that just grew revenue by 29% is down nearly 10%, we need to look under the hood of this sell-off. The prevailing belief, the expectation held by the majority of retail traders using the Robinhood app, or those managing their own capital via SoFi Investing, was that Snowflake would demonstrate massive operating leverage immediately. They wanted to see profits exploding alongside revenue. The reality is that Snowflake management decided to play a longer game, specifically by guiding for a 7% operating margin in the upcoming quarter, which fell short of the 9% the street wanted. This discrepancy, a mere 2 percentage points, triggered the sell-off. But here is the contrarian take that you need to consider, that margin compression is not the result of a broken business model. It is the result of a deliberate, aggressive investment in artificial intelligence infrastructure, specifically the $200 million expansion of their partnership with Anthropic to embed Claude AI models directly into the Snowflake data cloud. When you invest in NVIDIA stock, you are betting on the chips. When you invest in Snowflake today, you are betting on the data that feeds those chips. The market is selling the stock because costs are up in the short term, but smart money is likely looking at this as the necessary cost of building a defensive moat in the age of generative AI. The volume we are seeing today is immense, far outpacing the daily average, which suggests a battleground is forming between weak-handed momentum traders and long-term institutional accumulators. If you look at the flows on Fidelity Investments platforms or Schwab Intelligent Portfolios, you often see this kind of divergence during earnings season. Retail traders panic at the red percentage sign, while deeper pockets, perhaps those utilizing Fidelity Wealth Management Services or large Fidelity IRAs, start nibbling at the bid. The narrative that Snowflake is broken because it chose to spend money on securing a top-tier AI partnership is a shallow interpretation. We have seen similar overreactions with Tesla stock in the past, when margins compressed due to factory buildouts, or with Apple stock during transition cycles. The market demands linear growth, but true technological dominance is rarely linear. It requires periods of heavy spend to secure future dominance. The drop to the $239 level brings the stock back to a more palatable valuation of roughly 19 times sales, compared to its historical average, which often hovered closer to 35 times sales. For those looking to invest online and find entry points in high beta software names, this volatility is the price of admission. Let's strip away the noise and look at the actual earnings print that caused this commotion. Snowflake reported revenue of $1.21 billion for the third quarter, beating the consensus estimate of $1.18 billion. That is a solid beat. Earnings per share came in at 35 cents, again beating the 31-cent expectation. So the company is selling more product than expected and making more money per share than expected. The failure that the market is punishing is entirely forward-looking and speculative. Management guided for product revenue of roughly $1.195 billion for the next quarter. This was seen as light or merely in line. In a market environment where investors are chasing the explosive upside of NVIDIA stock or the steady compounding of Fidelity mutual funds, in line is treated as a disappointment. But we must contextualize this. We are talking about a company generating over $1 billion in revenue every single quarter, with a growth rate hovering near 30% at scale. That is a rarity in the public markets. Most companies trading on Interactive Brokers trading terminals would kill for that be a profitability story right now, whereas Snowflake is insisting on remaining a growth story for a few more years. It is crucial to talk about the Anthropic deal, because this is the centerpiece of the reality that the market is ignoring. By securing a partnership to bring Claude, one of the world's most advanced large language models, directly into the Snowflake data cloud, Snowflake is solving the biggest problem in enterprise AI: data privacy. When you use SoFi Active Investing or check your Robinhood crypto balance, you are interacting with secure data. Enterprises can't just dump their proprietary financial records or customer lists into a public version of ChatGPT. They need a secure perimeter. Snowflake is building that perimeter. The $200 million investment is essentially an insurance policy that ensures Snowflake remains the iPhone of data, the platform where all the cool apps are built. If they didn't make this spend, they risked becoming a dumb pipe for data storage, while other platforms captured the high-value AI compute layers. This is a classic case where the short-term stock price is lying to you about the long-term business health. If you are using Interactive Brokers stock trading tools to analyze the chart, you might see a breakdown. But if you look at the product roadmap, you see a breakout. This brings us to the broader landscape of online investment and how individual investors should frame this. Whether you are using Fidelity brokerage accounts or dabbling in Robinhood fractional shares, the temptation is to sell when the screen is red. However, successful self-investing requires understanding the sector rotation. We are currently seeing a rotation where capital is being very picky about AI exposure. It is no longer enough to just say, "We do AI." You have to show how you will monetize it. Snowflake's agentic AI push, software that can autonomously perform tasks for users, is their answer. The acquisition of crunchy data and the integration of these new AI agents are steps towards making the platform stickier. Stickiness is the holy grail for investment theses in software. If a customer builds their AI agents on Snowflake, they can almost never leave. That leads to high net revenue retention, which Snowflake reported at 125%. Think about that for a second. Even without adding a single new customer, their existing customers are spending 25% more year over year. That is a compounding machine that is incredibly difficult to stop, regardless of what the share price does on a random Thursday in December. I want to pause here and ask you a question to gauge the sentiment of the room. Comment below how many shares of Snowflake you currently hold, or if you are waiting for a lower price entry. Also, are you using any robo-advisor services like SoFi Robo-Advisor or Fidelity ETFs to get exposure to this sector, or are you picking these stocks individually? It is always fascinating to see how the retail crowd is positioning versus the institutional flows we track. Continuing with the analysis, we need to address the competitive risks, because they are real. We cannot discuss Snowflake without mentioning Databricks and the hyperscalers like Amazon and Microsoft. While Snowflake runs on top of AWS and Azure, those companies also offer competing products. It's a frenemy relationship. This is similar to how Apple stock benefits from Google search payments while competing with Android. The risk for Snowflake is that the cloud providers undercut them on price. However, Snowflake's advantage is neutrality. If you are a large bank using Interactive Brokers platform services or a healthcare giant, you likely use multiple clouds. You do not want your data locked into just Amazon or just Microsoft. Snowflake is the Switzerland of data, neutral, accessible, and portable. This